we're going to pick up the concept of adjusting entries with deferral of revenues. And simply put, a deferral of revenue, deferred revenue, is when a customer comes and pays us before we've actually earned the money. So if, for example, we say, if it's a construction project and the contractor says, I want a deposit of X amount of money before I book the job. The contractor hasn't earned that money yet, and so he shouldn't be recording it as revenue until the work has actually been completed that would account for that deposit. And so we wouldn't want to record that as revenue right up front. And depending on what the contract says, if the job gets canceled for some reason, that money theoretically should go back to the customer. And once that revenue has actually been earned, though, we need to make adjusting entries. And so I'm actually just going to skip over this to an example. Fast Forward has a client that paid them for 60 days worth of services in advance. That covered December 27th to February 24th. And so we get to the end of December and we have earned 5 days worth of revenue. So this was 60 days worth of services, and so we need to calculate what the per day service is, 5 days. So for 5 days of services, that's $250. So we need to record that we earned $250 of that initial payment. So we're going to, first record the cash on the day that we've been paid of $3,000, and then we're going to have unearned consulting revenue, which is going to be in a liability account until it's been earned. And so we're going to, now that we've earned $250 of that money, we're going to reduce the balance in the consulting revenue, which is a liability account. Don't get confused over the fact that it says revenue. It's a liability account, and debit entries decrease liability accounts. Meanwhile, over here on the consulting revenue side, and don't get confused about this $5,800. This has nothing to do with this transaction, and it's a little irritating that they included it in here, but this was from entirely different revenue. But this shows the 12/31 entry of that $250 for the 5 days worth of consulting revenue that was earned. We have a balance left now, as of the end of December, of $2,750 in the unearned consulting revenue account. Theoretically, depending on the contract, if the customer fires us at that point, we still owe them this money, and at a minimum, we still owe them the services for this money, so it remains as a liability until that money's been earned. And again, this is showing our income statement. And again, disregard the fact that $5,800 of this was for a completely unrelated transaction. But this is just showing the total for the month of December for consulting revenue. Here, Here is the journal entry that shows what the actual entry will look like in the journal, because we're not recording things in T accounts. That's just to give us sort of a visual understanding of what happens. The actual recording occurs in the journal, and so the December 31st debit to the unearned consulting revenue account, and the credit is to consulting revenue to transfer that money from the unearned liability account into the earned revenue account. And we're sort of humming along okay, so I'm going to actually stick with this video to talk about adjusting entries for accrued expenses. So accrued expenses are expenses that we have incurred, costs that we have experienced in an accounting period, but we haven't actually paid for them yet. So we can't ignore that we actually had some expenses and that we owe some money for those, even if we haven't paid for them. Fast Forward pays its employees $70 a day, or $350 for a 5-day work week, and they get paid every 2 weeks on Friday. 12/31 is a Wednesday, so that's going to fall before the end of the pay period. And so we've got 3 days of salaries that are going to be owed at year end, so Monday, Tuesday, and Wednesday for the last week. And so we need to record the fact that in our financial statements, we owed those employees, even though we haven't paid them yet, they'll get paid on the next pay period. But we owe them for the $210 of money that they earned, helping us generate December's revenue. And come on, there we go. So the journal entry will show up as a salaries expense, even though we haven't paid for it, and then salaries payable to show that we still owe for those 3 days of payroll. And looking at it in T account form, the salaries payable, which is the liability, our liability is going to go up, so that's a credit. And then our salaries expense, again, ignore the $1,400. That was from another pay period. Just look at the 12/31 adjustment because that's all that relates to this transaction of the $210 to record that salaries expense. So our balance sheet will reflect a liability of salaries that we owe of $210, and our income statement will show that we had a total for the month, including the prior pay periods, of $1,610 for the month of December for our salaries expense. At some point, the time will come where we then will have to actually pay for those expenses that we incurred. On the 9th of January, which is payday, we're going to record not only we're going to pay them for not only the 3 days that they had worked at the end of December, but the 7 more work days in January. And those are all going to show up on the same paycheck because it's one pay period. So we're going to have 2 different debits. One will be for the salaries payable to reduce the liability account for that $210, and the other one will be for the salaries expense of $490 that covers those first 7 work days in January. Because remember, we already recorded the salaries expense at the end of December for those 3 days. We're not going to do it twice. And then we will pay them cash for the entire amount that they are owed for the total of those 10 days that they worked. I'm going to wind up this video with talking about adjusting entries for accrued revenue. It is a very common occurrence that we will do work for somebody and we will send them a bill and they will pay us at some later point. We're still going to record the fact that we earned that money, even though we haven't been paid for it, but we absolutely need to record the fact that we are owed the money for that, and that accounts receivable is an asset to us. So at the time that service happens, it is a debit to accounts receivable and a credit to our revenue account. In our example, on 12/12, Fast Forward's customer agreed to pay $2,700 on the 10th of the year for future consulting services over the next 10 days. On 12/31, we have used 20 days worth of those services. So we haven't been paid yet, but we need to record the fact that we had revenue for the month of December. And based on the $2,700 over 30 days, that is going to amount to $1,800 worth of revenue. So we're going to make an entry for $1,800 to the consulting revenue, and that's going to be a credit. It's going to go up, and we're going to also debit the accounts receivable. Come on. For the $1,800, and that will ensure that our December 31st financial statements account for that revenue that we earned. So again, debit to accounts receivable on the asset side and a credit to consulting revenue. This $6,050 is from other revenue we earned in December, so ignore that. And this assumes that at the end of the December, we are just owed the $1,800 from this customer. Chances are we're going to be owed that from lots of other ones, but for the sake of the example, we're just going to look at this one. But meanwhile, our income statement example is, they've got not only this example, but the other revenue that shows $7,850 in revenue. So that magical day comes when our customer actually pays us. And when the customer pays us on the 10th of January, not only are they paying us for the $1,800 that for the work we did in December, but for the work we did for that first 10 days of January. So that whole $2,700 is going to cover both time periods. They are going to give us cash for $2,700, so it's going to be a debit to cash. We are going to reduce by crediting the accounts receivable for the 20 days in December of $1,800 and the consulting revenue for the 10 days in January. Now remember, we've already recorded the 20 days as consulting revenue in December when we earned it. We don't want to do that twice. All we're worried about with the December $1,800 is recording the fact that they paid us the money and that the customer doesn't owe us that anymore. We don't want to double count revenue and record it both at the same time that we billed the customer and when the customer paid us. We're only going to record the revenue once. So here is kind of in a nutshell the 4 different kinds of adjustments that we've talked about. The 2 kinds of deferrals and the 2 kinds of accruals. The deferrals, deferral of expenses and deferral of revenue. We've got the adjusting entries for the expense and the asset, the liability and the revenue. If we did not make those adjusting entries here in this sort of before adjusting column, this would show how our financial statements would be misstated because we failed to record these adjusting entries. And we don't want that to happen, so we want to make sure that we properly reflect the state of our financial affairs and not over or understate any of our accounts. And similarly with the accruals, this relates to things that we got paid or that we received after the expense, that we paid or received after the event took place. And again, the impact if we fail to make those adjusting entries. I will stop this video now and wind it up with preparing our financial statements now that we've made these adjustments.